Hello to everyone. Today I am here with State Bank of Pakistan Monetary Policy today's decision as on July 29, 2024. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. Now here we are going to discuss the factors influence the policy rate of any type of a country. Now, policy rate is announced by the central bank of the country. The Monetary Policy Committee observed the following developments since last meeting held on June 10, 2024. In Pakistan, and the central bank who used to decide the policy rate of the country is called State Bank of Pakistan. Now here, current account deficit narrowed sharply in financial year 24, and the State Bank of Pakistan's forex reserve improved significantly from 4.4 billion at the end of June 2023 to above $9 billion. So it's a significant increase, almost by $4.6 billion. Country reached a staff level agreement with IMF for a 37-month EFF program of about 7 billion. So it's an agreement. Definitely liability is considered to be a burden on any type of country. But anyhow, in this situation, it works as to rescue the economy of the country. Sentiment survey conducted in July showed a worsening in inflation expectations and confidence of both consumers and businesses. These are the views by the experts of the central bank. International oil prices have remained volatile in recent weeks, whereas the prices of the metal and food items have eased. With the ease in inflationary pressures and labor market conditions, central bank in advanced economies have also started to cut their policy rates. So we can say that it's the foreseen on the basis of that the central bank is going to cut down its country's policy rate. Real sector latest high frequency indicators continue to reflect moderate economic activity. That include auto and the petrol oil lubricant excluding FO sale and fertilizer offtake increase on month-to-month basis in June. Large-scale manufacturing also recorded a sharp improvement in May 2024, mainly driven by the apparel sector. That is considered to be the strength of the country. The growth in the agriculture sector, after showing a strong performance in financial year 24, is expected to slow down in this fiscal year. Latest satellite images and input conditions for the Kharab crops also support this segment. Activity in the industry and services sector is expected to recover, supported by relatively lower interest rate and the higher budgeted development spending. Based on this, the Monetary Policy Committee assessed financial year 25 real GDP growth in the range of 2.5 to 3.5% as compared to 2.4% recorded last year. These are the expectations. External sector, after recording surpluses for 3 consecutive months, the current account posted a deficit in May and June in the line with the MPC's expectations. These deficits were largely due to the higher dividend and profit payment and the seasonal increase in imports, which more than offset a significant increase in the exports and workers' remittances. On one side, we have the debt payments and imports. On the other side, in order to offset, we have export and the worker remittances. So here we are facing the deficit. Current account deficit in financial year 24 narrowed significantly to 0.2% of GDP from 1% in the preceding year. The revival of the financial inflows helped build the State Bank of Pakistan forex reserves. Looking ahead, the MCP expects a modest increase in imports in the line with the growth outlook. A continuous robust growth in workers' remittances, along with an increase in export, is expected to continue the current account deficit in the range of 0 to 1% of GDP in financial year 25. Now, this percentage is considered to be definitely not satisfactory. Fiscal sector, the government revised estimate indicate improvement in the fiscal balances during financial year 24 as primary balance trend into a surplus and the overall deficit declined from the last year. However, amidst a shortfall in the budgeted external and the non-banking financing, the government's reliance on domestic banking systems increased significantly. The committee expressed concern on increasing reliance on banks for deficit financing, which have been squeezing borrowing space for the private sector. That is definitely an alarming sign for the growth of private sector. And on the other side, no doubt in it, the banks feel secure if they are providing the lending to the state. For the financial year 25, the government has set the primary surplus target at 2% of the GDP. The MPC emphasized on achieving the invigorated fiscal consolidation and timely realization of planned external inflows to support the overall macroeconomic stability and build fiscal and the external buffer for the country to respond to the future economic shocks. Inflation outlook as expected. Headline: inflation rose to 12.5% year to year in June 24 from 11.8% in May. So it's also quite an alarming sign and painful for the general public. Increase with the primary driven by the high electricity tariff and the E-related increase in the prices, which were partly offset by the downward adjustment in the domestic fuel prices. Core inflation, meanwhile, has studied around 14% over the past 2 months. It's not a good sign. The MPCs assessed that while the inflationary impact of the financial year 25 budget is largely in the line with the expectation, the available information indicates that the full impact of these measures may now take some time to fully reflect in domestic prices. So that is also a concern for the general public. The committee also noted risk to the inflation outlook from the fiscal spillpages and ad hoc decision related to the energy prices adjustment. On balance, After considering these trends and accounting for the significantly tight monetary policy segment and ongoing fiscal consolidation, average inflation is expected to remain in the range of 11.5 to 13.5% in financial year 25, down significantly from 23.4% in financial year 24. In the meeting held today as on July 29, 2024, in which the committee decided to reduce the policy rate by 100 basis points to 19.5% from 25 to 20.5% based on the factors we have discussed. Thank you very much. See you with the upcoming video on the similar topic related to the banking and finance. If you are interested to have update videos on these topics, please do subscribe my channel.